There are lots of different flavors of investing. Even within value investing, there are lots of flavors, and it's important to emphasize that, what I'm going to talk about tonight is really, I'm kind of one small slice on that very big spectrum. So, I hope to offer you some of the ingredients for my recipe, but ultimately, you'll have to, find out what suits your own temperament and, what really resonates for you, and you'll develop your own recipes as well. So, after nearly 20 years at Third Avenue, I had to decide, what my next chapter was going to be. And frankly, I was kind of terrified because I hadn't interviewed for a job in 20 years. And my better half, she reminded me that I had terrible interviewing skills and that I hadn't written a resume. And so I didn't really know what to do, but I knew that I wanted to continue investing. And one thing that was very important for me was to try to align myself with good people. And in this context, what I mean by good people, defined as follows, right? People who have the highest levels of integrity, people who are financially conservative, and people who are passionate about investing. And, on that very short list of people that had checked those boxes, Bob Robotti and his team were kind of on that short list. And so I've been very fortunate and lucky to partner with Bob. And I've been with him for about 5 years. And I suppose, maybe I was well suited to be a value investor right from the get-go. I was kind of the black sheep of my family. Both my brother and my father were engineers by training and background. And when I announced that I was going off to get a liberal arts education, I could feel the disappointment in the room. It was heavy. But anyway, it's all worked out well, and I kind of regard my career in investment management as part passion project and mixed with a heck of a lot of luck. And in that vein, I really kind of owe a debt of gratitude to my mentor, Marty Whitman. This is a picture of Marty. It was really a fluke that I met him. I met him in business school, and it was at a point in the second semester of my second year, I decided to kind of try and maximize the value of my education. So I took an extra class, and I didn't really know what to do, but I asked a friend, and she suggested I take Marty Whitman's class, and I had never heard of this man. And but the way she described it seemed interesting, so I took his class. And I should note that I was on a completely different track in business school. I was gonna try and get a joint degree with the forestry school at Yale and, pursue a career in environmental studies and try and save the world. And, I took Marty's class, and, his not only his teaching style, which was very, very unorthodox, but the content of what he was teaching was completely different from anything I had encountered in school up to that point. He was kind of just blowing up the myths of the efficient market and talking about, how his experience investing in the real world. And, he didn't have a syllabus. He would just throw annual reports at us, say, read these for next week. And then he'd bring in some executive to tell a war story about, some investment that he'd been involved in. And so at the end of the term, he asked us to write a paper. That is a picture of the paper there. It still exists. I was looking at it the other day. It's getting a little yellow in some of the pages, but really that was one of the first points in my education where I felt like I wasn't working hard, that I just loved what I was doing. I discovered that I really liked the research process. And I think that, the quality of the work product showed through and it caught Marty's eye. And he asked me to come in for an interview after I graduated. And, I stayed for the next almost 20 years. So it was kind of like it was a bit of serendipity, a combination of luck and passion that kind of launched me onto this career path. I added one of his quotes here that I think captures the essence of a lot of his thinking, which was think like Main Street, not Wall Street. And I take that to mean, when you ought to be thinking like a business person, like put yourself in the shoes of somebody who's out running a business. When you're thinking about businesses, don't get caught up in kind of the mumbo jumbo that defines Wall Street thinking. I guess the other thing, and I feel like this is an important part to add, is that Marty really evolved his investing over the time that I was there. And when I arrived at Third Avenue, Marty, his investing style could have been described as deep value and almost like a cigar butt investor, the classic 50-cent dollar kind of investor. But post global financial crisis in 08, 09, I think he started to put a lot more emphasis on growth, specifically the growth in the underlying businesses. And so kind of watching that, arc of his, evolution as an investor was really influential for me. And, I almost think it's kind of like the parallels sort of the transition that maybe Buffett made, right? When Munger teamed up with him and kind of nudged Buffett away from the quote unquote cigar butt investing and got him to start buying higher quality businesses. I think there was a similar thing that happened for Marty. So I suppose the last part, and this is, I really want to emphasize this is a very important part of his character, was that he was probably the most fiercely independent thinker that I've ever met in my life, for sure. To the point where he could be almost antisocial. And, on the other hand, I think it was one of the key traits to his success. So having that, the strength and courage of his convictions, he often used to say that he'd rather be shot for a lion than hung for a lamb. And, I think it was really important for him in his investing. So, here we are at a value investing class. And I pull up this slide that, I think having watched that transition from Marty, it kind of frankly made me question the labels of growth and value. And to digress for a moment, I suppose that whole, debate about growth and value, some of this was contrived by folks like Lipper and Morningstar to help fiduciaries and institutions so that they could very quickly and simply, put investors into a box and make their life very easy. So it's some sort of convention that, outsiders to the industry have sort of decided this is the way the world looks. But I'm not so sure. I guess, I think what might have been a better slide here was a Venn diagram of two circles. And one of the circles is growth, and one of the circles is value. And where the two overlap, is what I kind of think of and define as rational investing. I mean, my partner Bob defines himself and calls himself really a valuation investor as opposed to a value investor, which I think is kind of a better description. And I think Charlie Munger also said that, all investing is value investing. It's just really a question. It's the idea that you're paying less for something than it's ultimately going to be worth, and that value relates to something. So I suppose what I'm seeking to do as an investor is to be rational and make rational investments. And I think that value and growth are also kind of very intertwined. I mean, we used to have a saying that there is no value without growth. And I think that kind of goes to that idea of, what is a value trap if the underlying business is not growing? So I guess the other point here in distinguishing this is thinking about how I describe myself as my investing style is that I think value investors and growth investors tend to ask different questions. Value investors tend to be intrinsically risk averse. They insist on quote unquote margin of safety. And they tend to ask questions like, what protects my downside and what can go wrong? Whereas I think, a growth investor tends to ask questions like, how much money am I going to make? And what's my return going to look like? So I think, the postures of the two kind of on a going in basis are a little bit different. And, I've been trying to seek the overlap in those two circles. So I've got that risk averse piece, that margin of safety piece, but I'm also kind of always testing and looking for, how is that underlying business going to grow over time? So I thought it would be helpful to think about what sort of traits I look for, but I also, in the spirit of margin of safety, we have to kind of invert things and think about, you thought you were coming to a class about I was going to come here and tell you how to make money, right? Well, I'm insisting that we spend a little bit of time on how not to lose money, because the truth is, in the math of compounding is that losing money is really ugly. And mistakes are inevitable. I mean, you will make mistakes. No one bats 1,000 in this business. And so that minimizing those errors really, really helps. This list is pretty simple. And these things seem very obvious, but I've been doing this for 3 decades and I'm still making mistakes, and 80 to 90% of the errors that I've made tie back to 1 or 2 or 3 things, on this list. I think I could run sort of an entire semester on mistakes. In fact, we could teach a class on my mistakes for an entire semester, and or at least 1 or 2 semesters, and some of them have been very painful. And I can just tell you an example. Within the last couple of years, I had a position in my portfolio that was relatively small. It was a 3% position in a portfolio where my positions tend to be 5 to 10%. So in my mind, this was a small position. Unfortunately, the stock declined 90% in the course of a year. So, and the truth is, I was also swayed because I had some very high-profile institutions as shareholders alongside of me. So I thought I was in pretty good company. The thing imploded, and when I look back on it, if I do a postmortem on it, it certainly would be a combination of I ended up overpaying for this thing. There were questions about the business model, and obviously my position size was way too big, and I was overconfident about what a 3% position meant in my portfolio. I suppose these are also just errors of commission, right? These are things that areas where one could actively get in trouble, but there are also errors of omission. And I suppose in my experience, the errors of omission where I've neglected something or just avoided something, they may be, I haven't quantified it, but I'm pretty sure they've been even more costly than my errors of commission. I suppose one way to approach investing is to kind of take a list like this and almost do a pre-mortem on an investment. In other words, ask yourself, where am I likely to get in trouble? What's likely to go wrong here? So, that's one way to approach it. And I think it's kind of a useful way to approach things. I've included this quote from Ed Visteurs. He's a famous American mountaineer. I think he's known for having climbed all the world's 14 8,000 meter peaks without supplemental oxygen. I think it took him something like 18 years to accomplish that. He's summited Everest 7 times. So he's kind of known for all all of these things. But what I took from his book was much more subtle than that. What I took away was his incredible preparation for his climbs. And I'm talking about months and months and months of preparation before he would go on one of these climbs. And the risk management that was involved with his climbing. I mean, it was all done with this idea of, trying to protect himself and his team and his clients, even with tremendous client pressure. When you spend that kind of money and time to try and summit one of the world's great peaks, he would tell people that he had to turn around before we summited to stay safe. So I was, really struck by this comment that the getting down part is mandatory, and how much discipline really informed his risk management. And it's kind of this idea that, as you go through the world and you're reading and learning about people from different disciplines, that there is applicability to investing. So having talked about, these are the ways that I've kind of gotten in trouble. I mean, it makes sense to kind of transition. Okay, well, what do I actually look for when I'm thinking about an investment? I kind of talked about rational investing as kind of being my North Star in terms of how I approach things where growth and value overlap. And I think, that can be defined by a number of characteristics. First of all, I'm looking for businesses with, very strong economics or a business where the economics are likely to improve. And specifically where, management has a number of levers that I can pull on to actually, credibly improve the business, and, where management teams have attractive reinvestment opportunities. So this could be things like, it could be operational. It could be, coming from working capital, for example, or, cost-cutting initiative, or, factory capacity that is underutilized and there's latent earning power there, or, a new product cycle, things of that nature that they're in management's control. They're levers, the real levers that management can pull on to improve the business. And another lever that management could pull on would be in the area of capital allocation, right? It could be debt reduction. It could be share buybacks and dividends. And it could be, in the area of mergers and acquisitions, if maybe the company has an ability to make some bolt-on acquisitions to improve the business. So I love to see those, multiple levers, and very specific and credible things that can improve the business, that are in management's control. And lastly, I mean, on this note is the just to be aware of external factors, right? I mean, they're hard to kind of rely on, but things like you could see, for example, during COVID, changing industry. There are a lot of industries that changed. I mean, we kind of looked at the building materials industry and the lumber and forest industry. There's been a lot of consolidation, not only ownership changes, but capacity rationalization. And as a result of all of that, the remaining players are bigger and stronger. And, they might be enjoying a new higher level of earning power as a result of that. Another external factor could be something like multiple expansion. You buy something that is really mispriced, can't always count on the multiple expanding, but sometimes something is so out of whack that the odds, put multiple expansion in your favor. I mean, an example from my own experience would have been something like when I bought Morgan Stanley shares during April of 2020. There were two things that happened at Morgan Stanley. One, of course, was very company specific. They had announced the acquisition of E-Trade. And a lot of people didn't like that. So the stock got knocked down on that news. But then, of course, the pandemic unfolded and everything in the capital markets got crushed. So at that point, Morgan Stanley stock was trading at about 70% of book value, despite having mid-teens return on equity, and it was probably trading at 8 times earnings or something like that. And I could see that the business was overcapitalized. There was a whole new layer of earning power that could emerge from the E-Trade acquisition, and that there was no guarantees, of course, what was going to happen, but I thought there was a good chance that the company should be at least worth book value, particularly because there was a very, very, very valuable wealth management and investment management business embedded alongside their brokerage and capital markets businesses. So lo and behold, I didn't know what would happen, but I knew the odds were in my favor that there would be some sort of multiple expansion, and that's what happened over time. So it just kind of, it's one of those things that to be aware of external factors where you can't bake them into the cake, but just to be aware of it in terms of what kinds of things might goose the value of the business that are, in this case, outside of management's control. And I'd say, what really has protected my investments has been this ability for management to continue to build value in the business, irrespective of what's happening externally in the markets. So having those multiple levers again and things, tangible things that management can do to improve the business seems to improve the outcomes in my investing. And valuation, of course, is very important. I'm going to put that aside for one moment because I'm going to spend a little bit more time on it. But it is a little bit of a bigger topic, so we'll do that in a second. But so once I'm kind of comfortable with the characteristics of the business and I can kind of identify how this thing might get better, I start looking at the balance sheet. I would get questions a lot of times about, well, what kind of leverage is on the business? And there is no sort of generic answer for what is appropriate levels of leverage in a business. It all depends on, it's very specific to the business. I think Michael Milken once said something like, business risk and balance sheet risk should be inversely related, meaning that the riskier the business, the less leverage the balance sheet should have. And so, for example, if you had an oil and gas business that's very capital intensive and cyclical, obviously more difficult to have leverage on a business, or more risky to have a leverage in a business like that. If you have a software business with recurring revenue, or a subscription-based business, or something with an electric utility where the revenues tend to be steadier, obviously cases like that, a piece of real estate with credit tenants on long-term leases, those are more leverageable assets. And I suppose, in all of that balance sheet analysis, it's really important to ask, how is this going to look when business turns down? Because as a long-term investor, it's almost inevitable that you will own a business at a point when it has a setback. And so it's key to really kind of ask, what's this going to look like when things go south for the business? In my experience, also the balance sheet can be really a competitive weapon. I mean, if you own the best capitalized business in an industry that hits a headwind, the balance sheet can be used by that company to invest in new productive capacity, or go out and do M&A, or expand the business somehow that maybe financially constrained competitors can't do. And then, of course, I have to mention that in thinking about the balance sheet, you also have to think about what's off the balance sheet. It's not in the financial tables, but it's probably in the footnotes of the company's filings. I'm thinking here particularly in terms of liabilities, things like litigation, environmental claims, pension obligations. Marty was very prickly about if you didn't mention or talk about something that was off the balance sheet that was significant, he really let you know about it. And I built up a lot of scar tissue that way. I can give you an example. It was one that still sticks in my craw a little bit when I talk about, areas to look. Spin-offs are sort of an interesting area. And some years ago, DuPont spun off a company called Chemours. And, it was sort of interesting because it was statistically cheap. So I started looking at it. And then I realized that DuPont had done what a lot of parent spincos do, and they stick a ton of liabilities down at the spin-off company. And in this case, at Chemours, there was a whole bunch of litigation and environmental claims, and there were environmental claims relating to cancer-causing chemicals. And so when I saw that, I sort of just, pushed it aside and skipped it. And, one of my friends who was running another fund said he pushed on with it and bought the stock. And, 2 years later, he had quintupled his money, and he kept reminding me about this and loved to needle me about it. But I said, look, I'm just different sort of risk profile. I wasn't prepared to own that. Well, sure enough, a couple of years goes by, and now these environmental claims are something, and they becomes a multi-billion dollar litigation, and the stock, gives up all of the gains that it had made in the prior 2 years. So you have to kind of pick your battles. And I would suggest that knowing, something about what's not on the balance sheet can be very valuable. Beyond sort of the business characteristics and the balance sheet, of course, there is, the leadership and the management and the governance. I have a distinct bias towards companies where there is, an entrepreneur or a founder or a family involved, or a management team that's evidenced very clear alignment with shareholders in terms of their incentives and their track record. And so for me, that's, it's a very important piece of making sure that we're all sort of singing off the same page. The so-called owner-operator setup is no guarantee of success. But what I've noticed is that when you have those kinds of ownership structures, there tends to be a certain conservatism in the finances. They tend to reinvest in the business, pretty aggressively, and they think about it on a long-term basis, multi-generationally, instead of, quarter to quarter. And so, I think I am just more comfortable with that sort of setup, and that's a very important kind of criteria for me as well. And then, after you kind of make all your assessment, and we'll get to valuation in a second, but it's kind of important to ask, like, what do you know that the rest of the market doesn't know? Like, why is this thing mispriced? And you have to have some ego to be able to go in and say, something that dozens or even hundreds of other investors don't know. And so I think it's just kind of worth considering, the bear case, or put yourself in the shoes of somebody who might be selling the stock and ask, why are they selling it? And there could be a host of reasons, but I think it's worth kind of contemplating. And then, when you get down to sort of thinking about executing on an idea, I kind of like to think about whether there is actually an asymmetry in terms of the return profile, in terms of that upside and downside, right? So for me, I tend to think about it in terms of a ratio of around 3 to 1. I like to see a 3 times upside for every one, turn of downside in anything that I can go into. I think that's a pretty good risk reward as a as I start out. So I think the upshot too is that, I've never seen a perfect investment. Nothing is perfect. Everything has something wrong with it. And you kind of have to decide whether those things, are deal breakers or not. So I'll kind of leave it with that. I promised we would talk about valuation a little bit. And I know this is a super busy, there's a couple of slides here. And if you've been in, I've seen some of your backgrounds. You've been in investment banking, you've been in private equity, so you know a lot about this stuff. It's no secret that you should kind of use multiple perspectives. But I find a lot of what goes on Wall Street, people are very earnings centric. There is kind of this primacy of the income account, as Marty would put it. People are frankly kind of lazy, and they like to just use earnings as a simple point to kind of make a statement about value in the business. But I think it's much, much more than that. And using multiple perspectives will also kind of keep you honest. Because something may stick out when you apply a different filter onto the valuation. So what I always encourage people to do, and myself included, it's not so easy, is kind of invert things again, take the stock price out of the picture and turn your screen off and just pretend this is a private business and start valuing the business without using the crutch of the public markets. So you can start it. I kind of assume always that business is going to be a going concern, and there's a number of ways that you can look at a business as a going concern. I try to make it certain adjustments to GAAP earnings and come up with what I think of as maybe like an owner earnings. Make some sort of assumptions about an appropriate level of investments for the business and what working capital is needed in the business and so on. And kind of ask yourself how much cash is actually kind of coming out of this business. I also kind of like to look at, where is the business today versus where has it been in the past, in terms of valuation and what's changed in the business, whether it's in the growth of the business or the balance sheet or, the profitability, and ask, well, why is it different today? Is it worth more than it used to be? Or is it, it doesn't tell you what the business is worth. It's part of being curious about the valuation. People rely on public company comparables, but again, one of the potential pitfalls is that there are differences in business mix and accounting and, levels of financial leverage and things like that, but it can be kind of a useful exercise. Preceding transactions, if you've been in investment banking or private equity, you probably see this a lot. You look at where, there have been sort of sales in an industry and deals on, arm's length deals in a business, and get a sense of the valuation from that. I suppose one of my favorite, reads is you pick up a merger proxy and you go into the background section and you go into the fairness opinions, and that kind of tells you how sad my life is when I sit around reading proxy statements, merger proxies, and I'm all excited about the fairness opinion. And the background sections are often interesting because it tells you something about the quality of the board process, right? You can kind of get a sense of what was the board doing, while this was going on, and so that's pretty interesting reading. You get a sense of when you look at a fairness opinion, and investment bankers invariably use this multi-valuation, multi-perspective. They'll use preceding transactions. They'll look at public company comparables, and they'll even do, oftentimes a discounted cash flow. One of my now large investors, and he was one of my competitors. We used to compare notes a lot, and he called discounted cash flow it's the Hubble telescope evaluation techniques. And what he meant by that was if you move it a fraction of an inch, you're in a different galaxy. And so it really is, I have a lot of trouble with using a discounted cash flow to tell me what the value of a business is. I tend to use it to get a gauge of what the market is implying about and what the market is discounting in the value of the business, as opposed to me trying to figure out, all the little variables and inputs to determine what value is. Sometimes you'll run into a business that's not making any money, and you'll have to kind of figure out, what the heck is this thing worth? Contrarily, for example, I can think about back in the start of my career in the late 90s, we went through the tech and telecom bubble. And at that time, there were a lot of telecom companies putting fiber in the ground, and they were spending billions of dollars doing this. And they weren't making any money, and they weren't likely to make money for a long time. So I said, how is this thing being valued? And when you compared the enterprise value and the market value of these things, the only thing I could compare it to was the capital, the PP&E that they had just spent, the last 3 or 4 years building out these networks. And in many cases, that the market values were multiples of the PP&E that they had just put in the ground. And I said, this kind of made no sense to me. So, but it was just reflective of the times, and it was one measure of, how one way to measure like what something is worth. I felt like I could go out and borrow money at that time and pay 1 times the asset value rather than pay 5 times, which was what the ask was in the public markets. So this is kind of a tool to use when the earning power is not there, or temporarily disappears, or there's something else going on that's hiding the earning power. I guess the last couple little comments on valuation. If you really want to I guess keep yourself honest. One way to do it is to come up with your own little LBO exercise. Go out and find out, figure out how much equity you need to put into paying let's say a premium for the company, and what the banks would lend, and what mezzanine lenders and high yield lenders would lend on that kind of business, and just do the whole exercise, and you get a pretty honest answer and good feedback from putting something through, I think, an LBO exercise. This is there's more pieces to this, and I'll just kind of wrap it up with a couple of comments. One is, I think it's really important not to do this with precision in mind. I mean, I always kind of come up with a range of fair value. Clients are very they expect you to be really kind of smart and to the point and say company is worth X, but that's just not true. There's a range of value over which a company, I think, has you can say there's fair value in there somewhere. So avoid precision, and be aware that corporate values are dynamic. They're not static. They tend to change over time. They don't change nearly as quickly as stock prices, but it does kind of inform the sell side. I know a number of folks who say they're very disciplined and rigorous, and when a stock gets to 90% of the high end of their valuation range, it's automatically sold. And I tend to not be that so dogmatic in that regard. Selling tends to be very, very hard. There was a famous investor named Phil Carret. He had He was an interesting guy. He founded the Pioneer Funds at one point. He was, I think, an aviator in World War I. He lived to be over 100 years old, but he made the comment that selling is usually reflects a failure of judgment, and it's very hard to know when to sell something. And that really kind of stopped me in my tracks, because every time I sell something now, I think of that and I said, well, why am I selling it? Did I not want to own this in the first place? And that idea that selling is kind of a failure on the front end part, the going in part is kind of an interesting concept. So selling also kind of gives the idea, gives your clients the impression that you're actively managing the portfolio, right? So there are a lot of things, I guess when you start talking about valuation and then things go well, all of a sudden the stock is approaching, some range of value that you've determined. Just be mindful of some of the pitfalls around selling. I mean, particularly this idea that corporate values are dynamic, and over time they tend to grow over time if the business is doing well. My own sell discipline, I suppose it really goes to three conditions. One would be what I call gross overvaluation, where I feel like there's a high probability that my capital can be impaired, that there isn't an adequate margin of safety, and that the stock reflects kind of growth and value over a medium-term time horizon, which is just not realistic. Secondly, I would sell something if there were altered business economics, and I'm referring really to kind of that idea that there's something's happened either competitively or a regulatory thing, or there's been some secular change that is really an existential risk to the business, and that the longer term economics of the business are going to be altered. I would sell under that condition. And then thirdly, I would sell if there was just a superior opportunity. I found something that was more attractive than something that was in the portfolio. I would consider selling under that condition as well. So, that's kind of going back to the prior slide and talking about the characteristics that I look for, the balance sheet and management and the governance, and then valuation. I mean, those are sort of the things if you think about that slide that I put up, how to lose money in investing. Well, these are all kind of the things that I think about to try and protect myself, and those are sort of the qualities that I seek. I think now again it would be part of the trick in investing is how to find ideas. But I'm going to ask you to think backwards again for a minute in trying to find ideas, because I think it can be really helpful to start with, what to avoid when you're investing. Charlie Munger had this idea. He said, we try to find the 1 foot hurdles, not the 6 foot hurdles. What I think he meant by that was he and Buffett are trying to make their life simple, right? They're trying to find the simplest investments. They are, I suppose in my own experience, the best investments that I've had really have been the simplest ideas. And it's kind of counterintuitive. I mean, I'd love to tell you that I make a detailed 20-page write-up on all of my investments. But if you were really to think about, if you went into my files, you'd see that the companies that are the investments that are most troubling have the thickest files, and the best investments always tend to have the thinnest files. So I don't, this idea of simplicity is really interesting. And you can make your life simpler. There's just a whole slew of things that you can start by just putting them in the too hard pile, or putting them in the they don't qualify pile. And it could be things like people who have just evidenced bad behavior, not just toward the shareholders, but just kind of questions around their character. certain businesses are just run by people who are innately promotional, and you can kind of listen to them, and it's not. It tends to turn me off, but I have to be. It's part of that idea that no investment is perfect. I mean, I won't eliminate something just because I don't like the sound of management, but over time you kind of accumulate a knowledge of, and a sense of, what's motivating these people, and how are they incentivized, and then there's a whole slew of companies that they get into mergers, and those mergers are challenged either financially or commercially or even culturally, right? Companies that have built up too much debt and accumulated too much debt after a series of acquisitions. And there are businesses like a Blockbuster that, they're just facing an existential threat. And you might be tempted to go into something like that because it appears really cheap. They're affectionately called melting ice cubes. And then there are businesses that, other smart people own. Something like a Kraft Heinz, right, where Berkshire Hathaway and 3G are, kind of put those companies together. And I find myself sometimes just saying, well, gee, so-and-so is really smart. They own this company. I really need to take a look at it. But it's not always the case that these businesses are great investments. So it's just this idea that, there's a whole slew of things that you can start out every day by making your life easier. You don't have to own all these things, right? You can just put them in the too hard pile, or the, they don't qualify within your investment criteria pile. You got to remember that this is like the proverbial baseball game, right? You're sitting with the bat on your shoulder. You don't have to swing at every pitch. There are no called strikes, and you don't have to own these things. So that's kind of how you kind of eliminate a whole bunch of things, and one way to deduct your way into, like, how are you gonna kind of find ideas. When I started out in the 90s, it was great because I would have to call the IR person at a company and request an annual report and a 10Q and a proxy and the press releases. And a week later, this package would show up in the mail, and I'd have to open it up, and I'd have to type all the numbers in manually. And it was a very inefficient process. And I thought, oh, gee, I've got a leg up on other people. But today, obviously, information is and all the data is commoditized. You can get all of the stuff online. I think by the late 90s, the SEC was requiring companies to put their financials, online. So it started way back, and with so much available, I mean, anybody can kind of go in and, start really asking the same questions about looking for companies with high growth, high returns. So, what do you do? And there's a few places to start. I think these are areas where, and things that I think you can put to your advantage, right? There's tremendous amount of short-termism on Wall Street. So if you just lengthen your time horizon, you can have a huge advantage on other people. I mean, that short-termism even goes to kind of the sell side, right? They're not going to recommend a stock that's going down or where the earnings are going down. It just can't do it. So take advantage of that short-termism, that myopic focus on quarterly results, expand your time horizon. Temperament kind of ties to that as well. I mean, it's this idea that you can sustain a down period in the stock. Your investor base allows you to do that. You can sustain sort of bad news in the business for a period of time. And, you can have an advantage because, there's so many other people who look at things like that and say, it's just dead money. And and they move on. And even it happens with companies, that, when investors own something for like 3 years and the stock hasn't moved, and they just get exhausted, and they sell it based on that, and you can take advantage of that. So the other area, one thing there are informational advantages, and it comes out of places that, are neglected or that are complicated, and things like conglomerates and spin-offs, and there's corporate action, either there's a divestiture or company makes an acquisition. And in that process, particularly, things like spin-offs, there is an information void. There's a period of time when you simply, the numbers are not out on Bloomberg, or they're not on FactSet, they're not on Capital IQ, and you can go into the documents and get your arms around, the numbers and understand what's happening in that situation, and take advantage of that. So, and then lastly, I have a number of investments where there's a structural thing going on. Sometimes it's related to just an orphan small cap name, but sometimes it's more structural. So I own stock, for example, that multi-class shares of stock. Sometimes I own a stock called Liberty Broadband. There's multiple classes of shares. A lot of institutions won't own multiple classes of shares because they don't like the kind of governance implications. But and in this case, there's limited liquidity, so they'll just avoid it, and that creates a mispricing in the shares. So there are a number of things that are available if when you're thinking about it, right, and kind of using the information differently, trying to do something differently, and as I call it, fishing where others are not. The person in the photo looks a little familiar. That is yours truly. And it wasn't one of the happiest days of my life. I think I set a record on that lake with that fish, at least for a little while. But so let's put some meat on the bones and talk about a couple of investments. And I know we're kind of running, time wise, I've been running a little long here, but I'm going to give you 2 quick snapshots of 2 of my larger holdings. FRP Holdings is a company that I've owned since 2016. It's a holding company with interests in real estate, and it's got a wonderful construction aggregates, mining, royalties business. This is kind of what I'm talking about in terms of information. I mean, this is a screenshot from Capital IQ, and if you were screening for the company, this is the kind of information you might get. It doesn't look very attractive. I mean, it doesn't look like it's very profitable. It looks like it's wildly leveraged, and it also looks like it has kind of a wild valuation. So I think if you were trying to screen for this, it just wouldn't get through a lot of screens. And yet the one piece off of this that really does catch my eye is the number around the float, and that can be seen in the kind of upper right gray box. That you'll notice that the float says that there's only 68% of the shares are free float. And that tells me that there's an inside owner, a large inside owner, or a group of owners. And as I said earlier, that's always kind of interesting for me. But the way I came across this business was it goes back in time. I mean, I started following the family that started this business back in the 1920s. I started following a company called Florida Rock back in 2007, and the family that started Florida Rock, the Baker family out of Jacksonville, Florida, sold their baby to Vulcan Materials for $4.5 billion, kind of right at the peak of the housing bubble. And I said, wow, this is a really interesting family. I should follow them. So kind of kept, loose notes on what they were doing. In 2015, as I was kind of getting ready to join Robotti, I see that they had a related company called Patriot Transportation, which had been spun off from Florida Rock in the 80s. Now Patriot Transportation was splitting off kind of its real estate holdings and its fuel transportation business. So this was kind of an example of corporate action, right? There was going to be this split off. There was information void happening, and it was already a small cap to begin with. So now we're taking a small company and splitting it into two. And so I said, well, this is going to be interesting. This is a interesting group of entrepreneurs with a great track record of value creation. I ought to take a look. And sure enough, it took a lot of work to kind of go through the business. And it was both painful and rewarding. I mean, to kind of peel apart the balance sheet, I had to kind of recast everything. And when you did that, it kind of looked like this. So the multifamily JV section wasn't there back in 2016. They've kind of built that over time. The mining royalties business was there. It's continued to flourish. It's a wonderful business, very high profit margin, no CapEx business where they just collect royalties from companies like Vulcan Materials and Martin Marietta and Cemex. The development business is a whole group of different investments, and the cash at the business is a result of the fact that they sold their light industrial portfolio to Blackstone for $350 million back in 2018. So, if you go back to the first slide of kind of statistically, it looks kind of like an ugly duckling. But when you peel apart the layers of the business and recast it, it gets to be a lot more interesting. So I think at this point, the business has a number of growth levers. They've got a whole bunch of funded projects. They're going to add to the earning power of the business over the next 2 to 3 years. So pretty excited about this business. I really like the management. Their mantra is, do no harm. Very, conservative financially. So kind of checks a lot of the boxes. And the family and the executives own 34% of the company. So, I sleep pretty well at night knowing that our interests are aligned. Second company is a company called Exor. It's traded in Amsterdam. It's the holding company for the Agnelli family, who are from Italy, and their story goes back multiple generations as well. But Exor is a whole mishmash of mostly publicly listed assets. So I call it value hiding in plain sight. They have stakes in Ferrari and Fiat Chrysler and CNH Industrial, and they're in the process of monetizing their interest in a reinsurance company called Partner Re. But this is just a grab from their annual report, and it's all available for everyone to see. When you add up the sum of the parts, you find out that the market price is at something like a 30% discount to the sum of the parts here, and there's probably lots of reasons why. But I kind of look at this and say, essentially, I've got a wonderful capital allocator who charges me about 10 basis points. 10 basis points of the asset value to work as magic. And, I worry less about whether that discount to NAV will grow than much more focused on, whether the NAV itself is growing. And, in that regard, they've got a pretty good track record. I don't say this is what the future is going to look like, but they've been pretty good capital allocators over time. And again, very well financed and are willing to monetize assets. I mean, this is a company that, John's grandfather and kind of the family, date their history back to the founding of Fiat and really the industrialization of Italy before World War II and in the periods after. And so, anyway, the family is, I think, very, very aligned. Their capital allocation has been superb, and they've done nothing to suggest that they're going to do anything that's adverse to the outside passive shareholders. So, and they're not just, and they're importantly in companies like this, they're not just caretakers, right? They really are bringing a lot of entrepreneurial energy to the portfolio. And so I think it's, again, this is one of those ones that people get very focused on the discount to net asset value, and people are frustrated because they keep asking, well, how's that discount going to disappear? And, if the discount sustains itself, it does move around a little bit, but I'm much more focused on whether the underlying NAV is moving in the right direction. So, an interesting capital allocation story. And with that, I'll kind of wrap it up. I've included in my slides, some books that I, have really enjoyed over time. Some of them I've read more than once. And I'm sure you guys are familiar with many of these, but there's a much longer list. And but I'm happy to share that, and we'll go on to Q&A.
Just a quick question until the students start getting their act together. So, Curtis, what is your day like? So you go there in the morning, and what's your day like?
I kick my feet up. I get a second cup of coffee. No, I try to map out a little bit of my day. I give myself a little bit of a to-do list, and I do that partly as a way of trying to avoid distraction. And so, it could be just reading 10Ks. It could be number crunching on a spreadsheet. It could be phone calls to people, or some combination of all of those. I try to avoid looking at my stock screen and the news and things like that. But I try to just chip out a lot of projects. I don't have a lot of turnover in the portfolio, so a lot of the time is just focused on the companies that I own and the ecosystem around those companies, whether it's a competitor or a supplier, and trying to do some thinking. I do, I was kind of making fun of having these elaborate 20-page papers and analyses and trying to keep things simple. But I do feel like it's very important that you write down your ideas about an investment to kind of hold yourself accountable and keep yourself honest. And frankly, in my case, because 3 years go by and I don't remember why I owned something from 3 years ago, so I write it down, and then I have a record as to why I own something and what my expectations are. And so that is a practice that it is time consuming, but I think it's important.
Okay, good. Okay, so Mo and then Trevor. Mo?
Awesome presentation. Thank you for taking the time. I guess one thing we kept discussing in class is that value investors spend around 80% of their time reading articles and whatnot, just looking for that smoke, looking for that any signal that triggers there's an issue. So I'm just curious if there's any resources you use to just kind of look for that smoke.
So Mo, were you talking? I had a little bit of trouble hearing you. Were you talking about? Was the question about a moat?
No, the question is what resources do you go to? What dependable resources do you use to kind of keep tabs on companies or news, like certain websites, certain newspapers? Kind of what resources you go to?
Well, I mean, my basic sort of tool is a Capital IQ. So I can kind of use that to pull down financial information, and we have a Bloomberg access, and I try to spend a lot of my day kind of just focusing on corporate documents. I have a whole collection of kind of website links to trade associations and things that are in industry that I can go to, so that if I'm looking at a company, there might be 3 or 4 websites or things like that I kind of would go to first to start getting up to speed or refreshing myself on something. So, I don't have it really, I mean, much of my time is kind of spent focusing on individual companies, and my tools are frankly, pretty limited to the things that I mentioned. But I do spend a lot of time also one of the probably important tools is looking at what other people are doing and people who I respect. I try to read their letters, I go to their websites, I go into their portfolios if they're publicly available, and try to get a sense of where, other people are, what other people think about businesses, and that is part of my idea generation process.
So do you follow other investors, activists, especially activist investors? Do you follow them and see what they do? And
not specifically activists, but there are a handful of investors who, their kind of approach resonates for me, and so I try to keep up with them. And I have a pretty concentrated portfolio, so it's low turnover. So I don't need to have tons and tons of new ideas every year. If I find 5 or 6 or 7 things during the course of the year, I'm pretty happy.
Okay. Trevor and then Urfa.
Yeah, thank you for joining us, Curtis. You mentioned tuck-in acquisitions in the early part of your presentation. And so I'm curious as to what is your typical sentiment towards tuck-in acquisitions? And I guess what different factors do you consider when you try to determine if it'll be a value add or if you think it'll destroy value? Even thinking about how you brought up the acquisition of E-Trade by Morgan Stanley. Why did you feel that investors were being over pessimistic in that case?
Thanks, Trevor. And it's a good question about acquisitions. In the case of Morgan Stanley, I just tried to gauge sentiment a little bit. I know a number of people that work, at senior positions in Morgan Stanley, including one of my college roommates works there, and some other people that I know. So I just kind of called them and I said, well, what do you think about the E-Trade acquisition? And they all kind of pounded the table and said, no, we should be buying back our stock. We should be buying. And I'd push back and say, well, this is a great way to diversify Morgan Stanley's revenue streams, and it comes with a whole bunch of customer base that Morgan Stanley does not currently have, and some technical tools that Morgan Stanley doesn't have. So I got a sense that they're, that at least some people didn't like this idea, but I liked it, and it was coming at a difficult time. But the broader question of acquisitions, I don't tend to like. I think roll-ups, the kind of classic roll-ups can be sort of tricky, but there are ways if there's enough disclosure around, and you can kind of ask management, if they're willing to share, like what, not the exact terms, but to, a way to think about the returns that they're getting on their acquisitions, and over time it'll show up. You can look for things like whether they've had to take write-downs, in subsequent years, or whether people are leaving, or and certainly whether the earning power that they were talking about 2 or 3 years ago is now starting to emerge, and if they're getting added earning power, how does that relate to what they paid for the acquisition? So I think there are ways. It's not always simple, especially with smaller acquisitions, but a little bit of that depends on the management team and how much you trust their kind of capital allocation. I'm involved with a company called CACI right now. They're building out they're ostensibly like an IT services company, but they're adding kind of technology pieces to both, especially software to their portfolio. And, some of the values kind of don't strike me as really that attractive, but their track record has been pretty good over time. So I'm giving them the benefit of the doubt.
Okay, Orphan, then Ben.
Hi, Curtis. First of all, thanks for coming in and chatting with us today. It's really interesting to hear kind of the mindset that it takes to be a successful value investor. You mentioned that you make a lot of your own adjustments when doing valuation. You recast a lot of statements. I was wondering, do you ever make these adjustments based on what you think you can influence management to actually change about the business?
If I hear the question, it sounds like I might have my own ideas about where a business can get improvements, and sometimes talking to management, you get a sense of whether they share those views or not, and sometimes it varies a great deal, I think, between among different kinds of management teams and how open they are to shareholders' ideas. So generally I try to be pretty constructive in my conversations with management. There is one business in my portfolio. It's a Canadian company, and they went on kind of a massive expansion spree and put a lot of debt on the balance sheet. And I finally they made a large acquisition that was debt financed, and it's a commodity related business. So I started to get very nervous, and I did reach out to the management and said, I actually wrote them a letter, and I shared it with their largest shareholder, who is a private equity firm. And because I wanted them to kind of bring some pressure too. And so, at certain points in time, I will take a little bit more of an active stance, but as my old mentor reminds me, it's better to be a lover than a fighter.
Okay, Ben and then David.
Thank you. And thanks again for the presentation. I really enjoyed it. So one of the things you mentioned was that sort of short-termism on Wall Street can be a big source of mispricing for a lot of stocks, because Wall Street and the sell side is very focused on quarterly earnings and so forth. So my question to you is, as an investor or as an investment firm, how do you garner a capital base that allows you to be long-term focused and overcome that?
That's a $64,000 question, Ben. It's kind of the holy grail, I suppose, of investment management, is to kind of get an investor base that shares the kind of long-term investment horizon that you'd like. And I don't think there is an easy answer. I mean, I was involved with the mutual fund complex for a long time. Within that organization, we also had limited partnerships and separate accounts, and we had some very, very sophisticated institutional investors. And it was amazing, actually, to think that, in some cases, especially around the global financial crisis, to see how kind of retail investors reacted versus how the allegedly more sophisticated institutional investors reacted. And, in many cases, the retail investor was much steadier and, longer term focused, believe it or not. So I've seen many hedge funds, kind of have the rug pulled out from them by their large investor, by, a large investor. And so I suppose it's a combination of not only finding the right kind of, similarly aligned people, but kind of having the balance within your own capital base to make sure that there isn't one single person or institution that's so large that can, introduce blow up risk to your organization. And there isn't really a magic bullet for that. It's just, one by one. That's why I manage a tiny capital base right now, but I will say that investors, I think, are all kind of aligned and don't bother me, when there's a bad period. I hope that continues.
Got it. Thank you.
Thank you, David.
Thanks for the presentation, Curtis. My question is around like how intimate are you involved with like the management of the companies that you're invested in? And the reason I ask is we've had some other presenters come in, admittedly more on like the Canadian value investing side, where market caps of these companies are probably, call it sub 500 mil Canadian. And so with that, it's probably a lot easier to get a hold of management and have those more robust quarterly updates. And of course, you being in what I think is New York, so obviously you have a lot of players in the market, and management might not be picking up your phone call specifically. So how are you, I guess, affirming that management's moving towards your thesis and really you're going to realize that value? And then again, is that where you decide, okay, my thesis is X, all of a sudden management's doing something a little bit different and I'm not really following what their strategy is? And is that where you start pulling your position off the table a little bit and taking risk off the table? Or what does that thought process look like?
Well, I would say that, there's an awful lot in the public record that you can get to sort of, take management's temperature. For example, you can listen to, earnings calls and presentations and just kind of get a sense of how management's thinking. There's an awful lot in the public filings. For example, in the US, they have, proxy filings. You can see what management's incentives are and, how they're compensated and things of that nature. And I try to, if I'm talking to people inside an organization, I try to ask some questions about, sort of the soft side of the business, the things about culture and incentives and how it's guiding behavior and how people are treated and all of those kinds of things to get a soft sense of the business. But yeah, I mean, if I, then some of my, in a company like Exor, for example, it's a pretty large company, and I really, I can go to their meetings and talk to people in the business, but I'm not, I don't have a direct line to John Elkann. When I was at Third Avenue, John Elkann came in our office, made a presentation to us. We could talk to him face to face, but we were, that was a relatively large organization. So a company like FRP, which I talked about at the beginning, is a $500 million market cap. So, I know the chairman and the CEO and the president and the CFO, and I have their cell phone numbers, and I can call them and have a dialogue about a certain project, that's kind of pretty cool. They know that I'm around for the long term and I'm not trading the stock. And so I have pretty good, insight on a company like that.
Awesome. Thank you very much.
Okay, we're getting close to the end of our time. So let me ask the last question. What is the most important thing you learned in investing and in life over the last 30 years?
I think it would go to this idea of continuous learning. The one really wonderful thing about investing is that I feel like there is no endpoint to learning. And, I kind of related this story that, at some points in my career, I would say to my father that I'm bored at my job, right? And he would say, well, just, there's always things to learn at your job. And my brother would kind of reinforce this too, right? He'd say, it's okay to make a mistake, just don't make the same mistake twice. And so it was kind of this idea of continuous learning. And I think if you are, I try to kind of have try and be humble and curious about the world. And I think, you can be open to learning that way. And I try to do a lot of reading. And I just don't think, that I'm ever I think I'm going to hopefully enjoy this for a long time because I'm learning continually. So, and it went to Marty as well. I think he was learning things well into his 80s when he was managing client money. And so, after 30 years of this, almost 30 years, I really enjoy it, and I feel like I'm still learning something new every day. It's like I get to come in and do a puzzle every day. Have a good night. Thank you very much. I appreciate your effort and questions and input. So thank you.